Hey guys, my name is Khan and you are watching Trading Hub. In this video, I'm going to teach you about liquidity and inducement. What is the difference between liquidity and inducement and how we can identify them and how we can utilize in your trading style. So most of the traders, more than 90% traders, don't know exactly how to mark structure in a correct way. Same thing apply in a liquidity case. Most of the traders don't know exactly where is liquidity and how we can identify them and how we can trade them. So in this video, I'm going to show you exactly how we can read market structure and how we can identify where is liquidity and how we can get high probability entry. So this video is a very important. If you are a SMC trader, this video can open your mind. Let's switch into the chart and show you exactly how we can read it. As you can see here, market momentum is a bearish and creating lower lows and break the structure. This one is our called break of structure. And then what happened? Market always price drop in a corrective way, not impulsive way. Market moves something like this. Okay. So what happened here? Most of the time, what trader do wrong thing is here, after break this structure they trying to sell here because there is available a order block, okay, and they still waiting for the sell. Market tap this order block and then sell and putting the stop loss just above it, and this order block induced to new smart money traders to sell here. But in reality this is just inducement. This is not a proper order block. As I told you in a starting, banks never trade based on the order block, not based on the structure. They trade based on the number of orders, where is the number of entries, where is the number of stop loss they introduce there. Okay, so in this case everyone trying to sell here, they putting the stop loss just above it. So smart money traders, which is actually banks and institutionals, they manipulate our stop loss, and after hit the stop loss which is here, okay, and then what happened? After taking out this high, and then market actually push a downside to mitigate this order block, correct? So at this point most of the traders introduce here for the sell, but in reality this is just inducement, correct? Then what happened? Market again break the structure in a downside and create move something like this, and same thing happen here. In this case you can see this low form here below, sorry, above this high. Okay, in this case market break this structure and push downside, and again they mark this is a break of structure, but in reality this is not break of structure. This one is just inducement to induce people to sell here. And then what happened? Same thing happen here, everyone trying to sell here. Okay, and this is our inducement, and after taking out this high you can see market push downside, correct? So this is our definition of the inducement in easy word. Okay, so inducement basically to induce people to buy and sell on a specific point. Inducement can be in a different condition. It doesn't means that inducement, this one is also inducement. No, inducement is here also. If you can see here, market pushing a downside and creating lower lows and creating a channel pattern which is here. Okay, those trade based on the chart pattern, okay, and structure. Then we can see here market break this structure is here and push upside, and then what happened? Some people aggressively buy on the breakout. Okay, and then what happened? This is inducing to people buy here, and then what happened? Everyone buying here. Look at the bullish engulfing candlestick to the upside, and then some people buy on the pullback at this point which is here. Okay, and some people buy here on the pullback and they expect price go higher, and then trying to push higher, and they're really happy because they know market pushing upside, market break this channel and they catch on the bottom. But in reality what happened? Because most of the traders introduce here for the buy at this point, and then what happened? Market push higher and then suddenly drop and collect all stop loss which is available here. Okay, and after collect this all stop loss, and then what happened? Market tap on this extreme demand which is here, and this is our trendline liquidity. okay, and then what happened, smart money enter here and then buy to the upside. So this is our liquidity because putting the stop loss just below it, and this is our inducement, this high and this breakout. Everything, liquidity and inducement, both are similar, there is no difference, like boss and chalk. Okay, so overall you have to understand where is the liquidity and where is the inducement, where is most of the traders trying to buy and sell, then wait for the sweep the liquidity and then enter, then very highly chances your trade gone in a profit. And liquidity can be in a different condition. It means this is a trendline liquidity. Sometime you can see some support resistance type of liquidity like this, and sometime equal high equal low, like you can say in a double top double bottom and moving average Fibonacci tools. And there are different type of liquidity available in the market. Every single high or low is a liquidity, daily candles high or low is a liquidity. You have to wait for the sweep the liquidity and then enter in the market. Okay, now let me switch into the chart, then I will show you exactly how liquidity actually work and how you trap in the market and how you can be different from other. Let me switch into the real chart. So as you can see here, market momentum is a bullish and creating higher high and market pushing upside. So most of the traders get confused here when they mark the structure. First they mark the structure like this is a boss, and again market break the structure, boss, again boss. Okay, and then what happened, market break this structure and then they think market turn bullish to bearish, and they expect again that market is a bearish, and they anticipating sell here and sell here because market momentum has been changed bullish to bearish. But in reality this is not a market bearish, this is just a trap for the traders who trade based on the smart money concept, and this is also trap for the retailers who trade based on the trend line. You can see how many times market tap on this trend line. You can see once market tap here, here and here and this point and again this point. So how many traders buying this point? Okay, and they put the stop loss just below it. Why? Because they are buying here and putting the stop loss just below it. And some other type of traders introduce here for the sell when market break this trend line, right? They anticipating price push downside, correct? Because market break this trend line and they put the stop loss just above it. Okay, so in this case you can see both side stop loss has been created. What market makers do in this case, you can see here, I'm going to show you exactly. First trap this sellers, okay, and then trap the buyers who trade based on this order block and this order block. They putting all the stop loss just below it, and these create liquidity. Okay, so when we can buy and sell, first wait for the liquidity sweep. In this case market is just bullish. Okay, there is no liquidity sweep, there is no inducement happen. After break this structure, where is our liquidity? This one is our inducement for the buyers and sellers. Okay, because everyone buying on this because this is a boss and buy here, and some people sell once market break this low and they introduce for sell here. But in reality this one is an inducement and this is our order block which is available imbalance proper, and they expect price go higher. Market tap here and push higher, market break this structure again, and then what happened, market push again higher high and creating new high. You can see again market break this low which is here, and then what happened, market again tap on this demand zone, this big is our demand, and then what happened, market push again higher high, and this one is our break of structure. Same thing happen here, this one is our break of structure. Okay, and after this break of structure you can see market taken out this high. After taking out this high, some people do again wrong thing is here, they buy here. That's why this is a bullish pressure to the upside, but this is a just trap. Okay, and this one is our inducement for the buyers. And let's see, so after taking out this low, you can see market tap on this minor demand zone which is here. Why I took this demand zone? Because market taken out this low and close above it. So this candlestick is our valid for the buy. Market tap here and push higher. So again what happened, market again break the structure is here, and after break this structure, this is our inducement. Okay, and after this inducement, where is our demand zone is here. Okay, again market tap here and push higher. Same thing apply in every condition. Okay, and lot of people get confused here, they trying to buy and sell on a wrong side. This is our entry model. We should follow the buy and sell. You can see here market create another trend line which is here, respect one and twice, and then what happened, market give reaction and then push downside and trap both side of traders, which is trade based on the trend line. And same thing apply here. You can see market again tap here and give a reaction and then push downside and mitigate demand zone and push higher. And these type of situation happen every day with smart money traders and also retail traders. So you have to wait for the liquidity sweep before the buy or sell. Before the inducement, don't take a trade. Wait for the clear confirmation. Remember two things in your mind. First thing is here, when market is a bearish, then always sell after taking out this high. Correct? Then you will get high probability setup and you will get a very highly chances that your trade gone in your profit. And same thing apply in a bullish market. When market is a bullish, then buy always break this low. Correct? So this is our key rule to buy in a bullish market and sell in a bearish market. And people get confused here, they trying to sell here because market break this structure, they trying to sell here and they manipulate. Why? All stop loss sitting below it. Then what happen here, market take all stop loss and push higher, then very highly chances if you trying to buy below it, then very highly chances your trade gone in your profit. And same thing apply here. In this case, market taken out the previous high and tap on the supply zone and push downside. And if create any type of liquidity on a trend line, then wait for the break the trend line. If market create equal low, which is here, okay, then wait for the sweep this equal low and push higher, then buy here. Okay, don't take trade without inducement, without liquidity. Okay, otherwise you will be liquidity. Buy when market break this low, sell when market break this high. Okay, and people do wrong thing, they sell here and become liquidity like this, and they sell here to tap this supply zone and they expect price downside. But in reality what happened, market push reaction in a downside and push higher and then go downside. Okay, you know very well where is market going on, but in reality you can't catch actual move. So apply in your trading style this rule, and this can be improve your trading skill definitely. So this is all about the liquidity. I hope you enjoy this video, and this video will help you a lot to understand things that how market actually work and how we can different from others. In this video enough for the day, and lot of videos are on the way, and upcoming week I will upload regular videos about smart money and smart money trap. So if you are new, subscribe the channel and don't forget to hit the bell icon, then you will get notification from our YouTube channel. So see you in the next video and happy trading.